Welcome to The Significance of Wealth with Tom Ruggie, founder and CEO of Destiny Family Office. I'm Marty Salt. In each episode, Tom brings you interesting topics and guests that reflect the independent thinking and tailored strategies he uses with his own multifamily office clients, exploring the evolving landscape of wealth management and ultra-high net worth, shedding light on the large sphere of alternative and private investments, and delving into the world of collecting as both a passion and investment strategy. Ultimately, he looks at success with a broad lens that may well transform the way we all define the significance of wealth.
Welcome to the Significance of Wealth podcast. I'm your host, Tom Ruggie, and today my guest is Jeff Chang, president of CBOE Vest, which I'll call Vest for short. Vest was founded in 2012 based on the conviction that investors desire more certainty in their investment outcomes, which led to the creation of target outcome funds. Vest manages $21.7 billion of assets. Jeff has over 20 years in the financial services industry and co-founded Vest in 2012. Jeff attended the U.S. Naval Academy and the McDonough School of Business at Georgetown University. Jeff, welcome to the Significance of Wealth podcast.
Yeah, thank you for having me. Great to be here.
Oh, glad you're here. So we'll get it kicked off. Tell us just a little bit about yourself, a little bit about Vest, and maybe the evolution of what's made the company what it is today.
Yeah, sure. So my background, actually, I started as a mortgage trader back in the early 2000s, and then cut over to convertible bonds and options, and then was mostly on the institutional side. And so me and my co-founder both worked for banks, and we came to the realization that a lot of our kind of derivative-based solutions can actually be put into other vehicles, such as ETFs and UITs. Mostly, after the '08 crisis, one of the largest issuers of structured notes was Lehman Brothers. And by providing a lot of these solutions that you see in maybe an annuity or a structured note, by having it inside an ETF or a UIT, or other types of vehicles, it largely improves from a standpoint, not only on a liquidity perspective, but it removes the credit risk to a bank and insurance company, right? Because the investor actually owns a fund that owns exchange traded options, and that counterparty is the clearing of the exchange, right? They have that they're not facing a promise from a bank or insurance company, which, like I said, also improves the liquidity of the solution potentially as well. And so that's really kind of the genesis, is the ability to bring kind of target outcome, defined outcome solutions, which had existed in other wrappers, but into the kind of the fund space, yes, utilizing, like I said, exchange traded options. Now, obviously, we then, given that we're pioneers in this space, first to ever file kind of a flex option based funds. That's when the Chicago Board of Option Exchange, CBOE, made a significant investment in the firm. So kind of the largest option exchange in the world and second largest stock exchange here in the United States. And then we also partnered, our other equity holder is First Trust, which is the sixth largest ETF issuer and largest sponsor of UIT. So we are really the genesis and kind of proud of kind of the partnership between kind of the three firms of the largest option exchange and one of the largest asset management firms out there.
Yeah, it certainly brings a lot of credibility to the firm to have CBOE listed as part of the naming of the company. So
yeah.
As I'm sure you're aware, our firm just initiated a strategy that we're calling the Destiny Target Outcome Fund 1,
yep.
Obviously with your firm. The reason we call it the first fund is because we do anticipate doing a second, third offering, et cetera.
Yeah. We
believe that the product that you all have created and put together just makes a ton of sense, certainly for our client base, but really, a lot of investors as a generality. The one hurdle that I personally had in talking to some clients about the fund itself and the structure is it's a relatively complicated structure. And even just the word options can scare some people away. Do you have a kind of a simplified manner of explaining what the portfolio looks like in concept to a layperson?
Yeah, sure. So usually when explaining it, I go through what the actual results that we're trying to achieve. What is it that we're really trying to accomplish here? And what we've seen in the history of options, what's interesting is that Cerulli Associates did a study out there. The two most frequent usages of options is downside protection and income generation. Is by far the two most widely utilized reasons for using options. In fact, a lot less, which kind of gives it options sometimes a bad name, is some people use it for leverage, right?
Right.
In case we're not trying to gamble on a particular stock or try to, in essence, like leverage a position. In this case, we're actually utilizing what most people want to do is create downside protection and generate income, right? And combine it to one strategy. Now, I'll start with one half of it because the strategy itself does two things, right? Income generation and downside protection. I'll start with the income generation first. Now, we're not recreating the wheel in income generation, more specifically in cover call writing, but we have noticed several different trends out there in cover call writing. And the first one is that you want to have an edge in your cover call writing, right? If you're not doing anything special, the markets are somewhat efficient, that it's really hard to generate a really good kind of performance if you're not doing anything that's unique. And I'll talk about that in a bit.
Okay.
The second component is that investors' cash flow needs don't change with volatility and interest rates. Meaning, you'll see a lot of cover call strategies on one period that they're yielding, 18%, and then vol drops, and suddenly they're going to give you 6%. Now, an investor doesn't suddenly say, "Hey, the VIX has dropped. I'm not going to go on vacation anymore," right? And so this is where we came and started our entire lineup of what's called target income products, where we target a specific level of income and we write just enough calls to get to that target, right?
Okay.
And so the most simplistic way I would say is that the first aspect is to write only on a portion of the portfolio and write just enough calls to reach an income target. Now, in our strategy, it's a 12% income target. We're going to write just enough to make sure that we generate that yield on an annualized basis and write just enough calls. Now, we're actually going to write some more calls to generate additional income to buy protection, right? To buy basically essentially a downside hedge to the strategy, right? And so that's kind of the most simplistic way of thinking about it is we start with an income target, write just enough calls to generate the distribution yield as well as the hedge for the portfolio. And like I said, the idea is to give up some of that upside, the growth opportunity for downside protection and the distribution yield.
But isn't there also a component of upside potential of the market as well?
That's right. So a common mistake that we've seen in years past, and you can even see this during COVID or 2008, a frequent mistake is you cover the entire portfolio. Because what ends up happening is the market will gap down, and then if it swings back up, you don't participate in the upside. Now, in our target income approach, we do two things. One is that we try not to cover the entire portfolio. We try to retain, well over 60, 70% of the upside. So only covering about, let's say, 20 to 35% of each position. Now, the way we do it is unique. And that's what is different of this strategy than what you would see in most other strategies, is that in many cases, a lot of people utilize index options, right?
Yeah.
They write a call on S&P. Now, when you dig a little bit deeper, when you look at an index is diversified, right? So if it's diversified, it has less volatility. It doesn't move as much. And because it has less volatility, that means when you sell the call, it generates less premium.
Right.
Now, if I take the exact same index, but I write on each individual stock, each stock by itself is not diversified. So it can have more volatility, and then thereby the calls can generate more premium. This allows the potential of not having to write as many calls to generate the income or cover as much to generate the income. But the problem is it's a lot of work, right? If you think about, even if you're doing 100 stocks, right?
That's an awful lot of work.
Yeah. It can be, millions of trades that you have to deal with, even on the assignment portion of it.
Because you're doing those trades weekly, correct?
That's right. And that's my second point is what makes it also unique is it's one of the few strategies that actually utilize weekly options. Now, why weekly options is I'd say a couple of years ago, it's always been more popular to do, let's say, a monthly option. But if you actually notice, the last 7 days is actually where a lot of the premium is generated, right? Because you sell a call, you want the premium to go to zero, meaning since you sold it, you want the value to drop. Now, you'll notice that drop occurs the most in a 30-day period in those last 7 days. So it's like football tickets, right? Like game times at 1 o'clock. If you go on StubHub at 12 o'clock, you'll see the ticket drop like a rock, right? That same thing occurs in options. And if you do that, let's say 4 times a month, as opposed to once, like I said, once again, but you can actually not cover as much to generate the premium which you're looking for, because you can take advantage of that accelerated decay that can occur in those last 7 days. So by utilizing single stock weeklies, we're able to retain a lot more of the upside and generate, like I said, also that additional premium to buy, let's say, a hedge for the portfolio.
Yeah, that makes a lot of sense. Hey, Jeff, I've got a question on performance that I'll get to in just a second, but before that, is there an ideal time of the market for this strategy, or is a kind of a almost anytime market strategy? But along the same lines, is there a timing perspective where this strategy would not work the way that we, of course, all would like for it to work?
Yeah, I mean, I would say, it's not unique as far as like in this strategy and in all cover call strategy. Obviously, if the market goes straight up, the strategy doesn't perform the same way as, a long only basket, right? I'll give you examples like year 2000, right? Just exuberance in which just the market's just going straight up, right? And that would be true with any cover call strategy. Now, what is good about this strategy is in most normalized markets where there's no irrational exuberance, the linchpin, like the secret sauce to the strategy is, like I said, notice we are going to sell single stock weeklies to generate our premium, right? Now, our hedge is going to be a 3-year index put at the money. So we're going to hedge with a 3-year index option. So notice the term of the option we're buying is 3 years, and we're using an index one that we're buying. Whereas the one we're selling is a single stock weekly. So in essence, what we're doing is we're selling the single stock weekly, the expensive option, to generate the income, but we're buying the index option 3 years, the cheaper version relatively, as our hedge. So I think to summarize and why this strategy tends to have more of an evergreen nature is really the secret is sell the expensive option, buy the cheaper one to protect yourself.
Yeah, makes sense. So I'm gonna talk a little bit about performance numbers, and mind you, I maybe should have come prepared with this, but I am going off the top of my head a little bit. But Vest ran for us a 25-year historical performance look back, and included with that was what ended up being, I think, 299 rolling periods of month by month in 3-year intervals, because our note is a 3-year note. And if my recollection serves me correct, there was only 2 periods that there was even a loss on the portfolio. And the worst, which was during actually, they were both during the 08-09 timeframe, but the worst over a 3-year period, I believe, was 1.88% loss. Yet the median return on all of those periods was roughly 46 or so percent, which is a very impressive return with some significant downside protection. So I go through that because one of the questions that I was frequently asked in talking to our client base about this, and you may disagree with this from your perspective, but from my perspective, talking to kind of the mass affluent, the question was, why is this strategy such an unknown strategy? Why do we not know more about it? Why is there not a proliferation of other firms out there like CBOE Vest doing this?
Yeah. So two things. Number one is I for compliance purposes, I have to say that from a back test perspective, that should not indicate any future performance, right?
Yeah, and we will have a compliance portion of this as well, but thank you for that.
Yeah. But I would say like this type of trade is not uncommon in the hedge fund space, right? The weekly options actually trade more than monthlies on the exchange. So there are people out there doing these types of strategies, mostly, like I said, on the institutional side, at banks and so on and so forth. So utilizing of weeklies or even single stock weeklies is not a new aspect to it. And if you notice, this is really like an option trade we call vol term structure trade, and these can be done on several different kind of different types of strategies. Meaning, like instead of just picking one stock basket, they could actually pick, let's say, a single stock. I hedge a single stock for 3 years, but I write weeklies against it, right? So, however, having this strategy across a kind of a broader equity basket is really what we're trying to bring, is instead of just having it in a hedge fund and taking advantage of, let's say, one particular position, let's utilize this in a broader sense and provide broader market exposure by, like I said, selling the expensive option and hedging the cheaper index.
Okay, makes sense. So, within our client base, one thing that we do is we use what I think most refer to as a bucketing strategy. We actually call it our pooled strategy. So, for example, our pool one money is what I deem as 1 to 10 year money, typically invested more conservatively, which allows the remainder of the money to be invested in a form that we can let volatility play itself out, because we're not necessarily needing access to that money for at least 10 years. So our pool 2 is 11 to 20 year money, and then pool 3 is what we deem as 20 plus year money, meaning that we would statistically suggest that based on a client's income needs, they should not need to tap into those assets in pool 3 for at least the next 20 years. Now, within the use of the Destiny Target Outcome Fund, we're actually classifying that as a pool 2 asset, although an argument could be made that it's a more conservative asset even. But our goal behind our 11 to 20 year money, even though this is a 3-year holding period, really is to have the potential to get somewhat of an upside return, not necessarily market return, but to be in that ballpark, but also to have some downside protection. So that's our methodology. I'm just curious, if you have an opinion on how other advisors would properly position this type of a product within their investment portfolio and assist investors in accomplishing their goals.
Yeah, this is definitely something a little bit more, given the high yield, it is an income play, right? I think, but because it has the downside hedge, it's hedging the downside. It's giving you a high yield, almost like a REIT, right? Where the income can be extremely attractive. But if you ended up with, like, let's say a REIT in 08, you have like a 30% drawdown that could occur, right?
Right.
This is allowing you as an alternative to say, hey, I can generate that income, have some of the upside, an attractive level of yield, but have some level of hedge where you're not going to be, down 30-40% if another 08 occurs. So really, for those types of clients that are near retirement or at retirement that need that level of protection, right? Yeah. I would not say this strategy is appropriate for someone in their 20s, right? Like where their time horizon is huge, because why would they need essentially the hedge per se?
Yeah, the protection.
Because their time horizon is so large. However, if I'm near retirement or at retirement, I can't afford a 30% drawdown, right? Like I don't have the time to recover from that.
Right.
And this is really where, by generating an attractive level of yield and also combining that with a hedge, can help and kind of fit in that spot where you have clients that are kind of in the stay rich game, right? Not trying to get rich per se. You know what I
Right.
mean?
Well, then what I found is most people that are rich are always in the stay rich game.
Exactly. Exactly.
Yeah.
So a lot of times I have friends that it's like, hey, should I buy your fund? I'm like, you're not rich. You're in the get rich game. These aren't really the products solutions for you, especially at a younger age where their time horizon's larger.
Yeah.
But really for those types of mass affluent that are in the stay rich game, they're near retirement, out of retirement.
Yeah. Makes sense. So there's ETF components of this as well. Would you suggest, is there any advantages or disadvantages to an ETF version of this type of strategy versus a direct investment into this type of strategy?
Yeah, so we have ETFs that also are target income, they generate income, and then we have ETFs that provide downside protection, right? Obviously the benefits of that is that you can there's intraday liquidity, so on and so forth.
Mm-hmm.
Now, this strategy is unique in the sense that it combines both of them into one strategy, where you don't have to go out and try to mix it yourself and try to figure it out. And because of the 3-year component allows us to be able to do buy a longer dated hedge, 3-year hedge, and combine that with single stock weekly call writing. That is what makes it kind of unique, is that combination is what allows for that, right?
Yeah.
And that's the benefit. So you give up kind of that liquidity for the term structure differential that allows for the strategy to exist. So the benefit really is that by having that, we can combine the two with attractive terms.
Yep, that makes sense. Just out of curiosity, do you currently or do you foresee in the future a role that artificial intelligence may play in target outcome funds?
I would dig a little bit, just one layer below that, in the sense that options are derivatives that point to stocks, right? I think, artificial intelligence, it does have some role in evaluating investments from a stock perspective, which from that layer and choosing kind of winners and losers in the equity markets can be helpful, right? Now, on top of that, then we just layer the option on top of whatever is selected from that equity basket, right? As far as option trading, like I said, option has to point to a stock. So from that standpoint, I think that's the first layer, right? Whereas a lot of the option trading is already somewhat automated, right? From a vol surface perspective. I guess there could be some level of calculation, but I think really the value add is going to be at the single stock level of selection because of the immense amounts of data. Because a lot of option trading is math, the Black-Scholes equation, right? It's not the vol and how an option prices is largely driven by how the stock behaves. And so I think that's where you may see at least the initial level of development in our space is how stock selection is.
Right. So for somebody that we're looking to structure something, but with a specific stock as opposed to a broader index.
Exactly.
Yeah, that makes sense. Can you share with us any hurdles or challenges, obstacles that you've faced and had to overcome?
Yeah, I mean, when we started, the flex option market wasn't well known to the SEC regulators because it wasn't really put into funds. They were around since the 90s. But as far as putting them into funds, we were the first ones to ever propose that to them. So that took a couple of years to get people comfortable and say, hey, what is this, right? So that's new. A lot of structural components that, and which is also why our partnership with CBOE has been very fruitful, is that a lot of mechanics of option trading had, I'd say, had not as much been in place. As an example, we have a gold target income fund, right? And GLD options stop trading at 4 o'clock. That's extremely difficult to manage a fund that you're pointing at gold,
right?
Where GLD stops trading at 4, and you're trying to trade options. Whereas let's say other options like S&P, they don't close till 4:15, right? And so as an example today, GLD options trade till 4:15 because we were able to move and keep everybody working for another 15 minutes. But those are the types of really neat things that kind of going through this that you're like, wow, gold trades another 15 minutes because of us, right?
That's pretty cool. Making a difference in the marketplace.
Yeah, everybody has to work an extra 15 on that. And I'm sure some people are pleased, some people probably not as much. They're like, you're running into my happy hour.
Yeah, exactly.
Yeah.
All right, Jeff. Well, I just have actually one final question. So I noticed that Vest just made the Inc. 5000 list. So first of all, congratulations on that.
Thank you.
But secondly, would love for you to share with our listeners what you feel has led to the success that you've had up to this point, but also what is your vision on a go forward basis? In other words, what's next for you? What's next for Vest?
Yeah, I think a lot of our successes, we have a tremendous team here and a tremendous partners at First Trust and Siegel Global Markets, and our partnership with First Trust has been always kind of shared vision as far as, what is it that we're always putting the advisor first, right? We're looking at what is it that our clients need, and because the advisor and the clients, they know what their actual needs and building solutions that they need and that they want. And I think that's been really kind of key to our success, constantly talking to our clients, constantly talking to you guys, the shepherds of the protectors of their wealth, and how do we do that? And what are the types of solutions that we should build, as opposed to building something that, we think up that we would want. It really comes from you guys and your clients and what their needs are.
Yeah, that's awesome. That's awesome. Well, again, Jeff, thank you so very much for your time today. I've loved the discussion, loved the information, and also love the products that are created, and look forward to working with you and your firm for many years to come, and maybe even having some outtake on different ways of doing things and creating some different options. But again, I love what you're doing. So thank you again. And so for listeners, we hope that you enjoyed today's episode of The Significance of Wealth. You can connect with us at destinyfamilyoffice.com, on LinkedIn, Facebook, YouTube, and Reddit, and also recommend our podcast on iTunes and Spotify. Thanks again, and have a great day.
On behalf of Tom Ruggie and Destiny Family Office, we hope you enjoyed today's episode of The Significance of Wealth and will continue to tune into future episodes. Connect with us at destinyfamilyoffice.com, on LinkedIn, Facebook, YouTube, and Reddit, and recommend our podcast on iTunes and Spotify. Until next time. The expressed views, thoughts, and opinions in this episode of The Significance of Wealth belong solely to the host and/or guests and are not investment recommendations or offers to buy or sell securities or private investments by Destiny Wealth Partners or its affiliates. This podcast is for informational and educational purposes only. The funds discussed are typically for qualified purchasers, defined as $5 million of investment net worth, exclusive of primary residence.